I'm Neetha Bidway, and this is Good Revenue. Today, we're going to get into some hot topics at the intersection of the economy and tech, starting with autos, tariffs, cybersecurity, AI safety, and then we'll also touch on some private markets and IPO updates. As always, you can find links and resources in the show notes. And if you haven't already, hit the subscribe button. Thanks for joining us. US autos are facing a huge set of shocks, starting with two bankruptcies. First Brands, they're a large auto parts supplier, announced a $50 billion bankruptcy, which was preceded only slightly by a bankruptcy by Tricolor. They're a subprime lender, and their bankruptcy is around $10 billion. Now, both of these come on the heels of CarMax's news. Their profits dropped from $133 million to $95 million, and they're feeling the effects of loan rates. Auto loans are at 7.6% for new cars and 15% for used cars. Subprime loan defaults are rising, and that is causing a lot of consternation as well. Now, across the board, auto sales are holding steady at about 1.23 million units, but that is being shored up by the fact that a lot of people are trying to buy electric vehicles before tax credits expire. Now, the auto industry is being kept afloat right now by electric vehicle sales, but the problem is that rising debt and costs are unlikely to change in the near term, and that means that the consumer pressure is likely going to stick around for the foreseeable future. U.S. tariffs are going to hit furniture and timber starting October 14th, and rates are expected to rise again in January. You can expect to see a 10% tariff on lumber and a 25% tariff on things like cabinets and vanities. That will increase to 30 to 50% in January of 2026. There are some exceptions for the United Kingdom and Japan, but across the board, the consequences of this mean that it's going to be more expensive to build a new home or to renovate your existing home. As tariff policy continues to cause real challenges for manufacturers and consumers, and it's going to hit homeowners in particular starting very soon. Is AI turning into a circular financing machine? You be the judge. Now, last week we talked about Nvidia. They made a $100 billion investment, just a couple of pennies, into OpenAI for a 10 gigawatt data center project. Now, their revenue forecast is $130 to $160 billion, but they're spending a lot of money too. In addition to the $5 billion they announced that they would invest in Intel, here's a long list of other investments in 2025. They're planning to spend almost $700 million in a British company called Nscale, $500 million in autonomous vehicle AI startup Wavy, $6.3 billion in cloud contracts with CoreWeave, and another $480 million in a Series D investment in Lambda Labs. Finally, they're spending almost $1 billion, $900 million on AI acquisition and licensing. Nvidia's business model nets an estimated $35 billion in chip revenue for every $10 billion that they spend. That's according to their publicly released statements. But the challenge here is that there is an AI financial flywheel that might be spinning faster than the business can actually support. The second data point in this question around circular AI financing, OpenAI makes just $13 billion a year, which is not that much when you consider the massive investments that they're relying on from Nvidia, Oracle, Microsoft, and other huge behemoths. Scaling costs are rising, and their latest research report shows serious deceptive behavior on the part of their model. That's GPT-5. Now, in this report, which I recommend looking at, they note that this behavior was mitigated for now, but given the importance of AI in critical systems, this is something we need to keep a close eye on. And one thing the report doesn't really address is how they'll be able to do that. And the third piece of data comes from PitchBook. Almost 2/3 of US VC deal value is flowing into AI startups right now. That is way above the level of past bubbles, including crypto and fintech. So across the board, late-stage AI valuations are spiking as investors are rushing to get a piece of the action, but there may not be enough underlying value to actually support all of this over time. Speaking of AI safety, California just passed the Transparency and Frontier AI Act. It seeks to balance AI regulation with AI innovation, but depending on your perspective, you may or may not agree with where they've landed. Here's the top line. This bill requires major AI companies to disclose safety rules, to protect whistleblowers, and to also report adverse incidents. It creates a public cloud system for AI startups, but it doesn't require an AI kill switch or mandatory safety testing. Now, this law is not nearly as strict as the law that the European Union passed that's supposed to go into effect next year. That's 2026. The California AI safety law is the first one in the US. And here's a little bit about how it compares with some of the rules that the European Union has put into place. California's law focuses on frontier AI models. So those are large-scale models with high training costs. That's how it's defined. In Europe, the law covers AI systems by risk level, so from unacceptable levels of risk to minimal levels of risk. When it comes to safety requirements, the California law requires public disclosure of safety protocols, incident reporting, but it doesn't require mandatory safety testing. In Europe, mandatory testing is required, and risk management is also required for high-risk AI systems and compliance with some standards for all models. The enforcement level in California, you have to report to the state, and there are whistleblower protections, but no kill switch. In Europe, there is regulatory enforcement, including market access restrictions if you fail to comply. The risk coverage is also different. In California, catastrophic safety risks are covered, as well as some financial thresholds and operational incidents. In Europe, there are broader systemic risks considered under the AI Act, including discrimination, privacy, and basic security. So across the board, there are some key differences between these two laws, and it remains to be seen whether or not Congress gets its act together and actually passes a federal standard that is comparable to the EU, or if they just preempt state law, and then we're left to deal with any adverse effects of all of this AI. Speaking of the opposite of safety, let's make a hard pivot and we will talk about cyber escalation. The latest news from Google and Mandiant, which is a company they acquired a couple years ago, Brickstorm is the latest stealth siege attacking US companies. And here is the top line. The Brickstorm malware campaign is quietly attacking US firms, primarily in tech and in legal services. It's been undetected for more than a year. The specific number is 393 days. And the problem that Google's threat intelligence report notes is that this means that logs that companies keep are often not for that long. And this makes it very difficult for them to figure out when this campaign first started. Now, Brickstorm is exploiting edge network devices and email servers. And this is very tricky because a lot of those edge devices have low or no security. They might be appliances or other things that basically are easy to hack and rarely get updated, which makes them a great attack vector for an adversary and very difficult for companies to defend. Brickstorm is the latest attack coming from hackers based in China, and it shows a clear and serious pattern of cyber escalation. So this is one to definitely keep an eye on. 3 huge stories coming out of private markets this week, starting with healthcare, video games, and social media. There's a huge fight brewing between Epic. They've been the dominant player in the health IT space for decades, and a startup called Abridge. Abridge has a $5.3 billion valuation, and they raised about $700 million in venture capital funding. They have a revenue pretty healthy at 100 million ARR, but they may not be a big match for Epic. The problem for Abridge is that they grew through a robust partnership with Epic. A deal that they signed about 3 years ago gave them access to more than 150 sites around the country. Earlier this year, Epic broke up with them by selling their stake, And they've just launched a new AI tool. So Epic has an AI tool that is competing with their former partner, Abridge. And this means that Abridge is scrambling to try to find new partnerships with companies like Athena and Cerner, other big players in health IT. This fight is showing the risks of monopoly and what the challenges can be if you're a startup in a space where there's really just one big gorilla. Speaking of big gorillas, private equity is taking a really big swing. They're going to take EA private. Electronic Arts is one of the largest video games makers out there, and they're going private in a $55 billion deal that's the largest ever, led by firms like Silver Lake. And then just down the road, our friends over at TikTok are also potentially still going to be in a deal. And this is one where it seems to be inching forward, and yet they haven't actually hit the finish line. So truly, who knows? This deal is interesting for a lot of reasons. The president just signed an executive order. This deal values TikTok at just $14 billion, which seems like a sweet, sweet deal in comparison to Electronic Arts and every other number that we've talked about here. Prior estimates for the value of TikTok were as high as $100 billion, so that's interesting. And in addition, this will still not go into effect until 2026 at the earliest. So we now know who the investors are in this new consortium around TikTok, and that's going to include Oracle, Rupert Murdoch, and Silver Lake again. What we don't know, the crucial sticking point, is whether or not the US will control the algorithm or if China still will. And that is a non-trivial point that has yet to be finalized. The latest news in industrial policy is that the US is in talks to acquire an interest in a lithium mine. Lithium is a key component for batteries, and you need batteries if you want to sell electric vehicles. See our first story for how important electric vehicles are for the US auto sector right now. US domestic capacity for lithium is just 2,700 tons a year, and demand is expected to hit 500,000 tons by 2030. DC is planning to invest $2.3 billion in a mine in Nevada. That's in addition to almost $900 million being invested by General Motors. And we've talked in previous episodes about the US investment in Intel and MP Materials. That is a rare earths mine. The US is trying to navigate serious supply chain risks that are global, both because of geopolitics and because of tariffs. And it's very clear that our US industrial policy is now to try to secure critical resources and to invest in supply chain that we have more control over. Now, the opposite of the US government having a stake in your business is the public markets, and it looks like IPOs are back. In 2025, there have been 255 IPOs. That's up 75% over 2024, when we had just 146 IPOs. The latest filings are Once Upon a Farm, that's Jennifer Garner's company, and Wealthfront. They're a robo-advising fintech company. Investors have been waiting for months and months for a good IPO market, and it's clear that lots of folks want to take advantage of it while this window of opportunity remains open. The key takeaways for this week. The U.S. auto industry is facing major stress thanks to two bankruptcies from a high-profile auto parts supplier and a top subprime lender. In addition, sales at CarMax, one of the top sellers of used vehicles, have been declining. Interest rates are sky high. They're 15% for used cars and 7.6% for new cars. The average price of a car is $45,000 right now. That's 10 to 15% higher due to tariffs. And the one bright spot for the car sector is electric vehicles. And that's just because people are pulling forward purchases before the federal tax credit expires. New tariffs are expected on furniture and lumber. That's going to drive up costs of home building and renovations. These tariffs go into effect in October, and they increase even more in January 2026. Nvidia didn't just spend $100 billion on OpenAI and $5 billion on Intel. They've also spent tens of billions of dollars on other AI companies, adding to consolidation of risk potentially in the AI sector. AI startup valuations are surging, and 2/3 of venture capital deal flow is going to AI startups. That level of concentration exceeds what we saw in crypto and the fintech bubble. California has a new AI safety law. It's the first in the nation, and it may force Congress to step up and provide some level of AI safety across the country. Even though some tech companies and AI enthusiasts are not thrilled about AI safety, this law is actually far less rigorous than the law passed in Europe called the EU AI Act, which goes into effect in 2026. Brickstorm is the latest devastating cyber attack. There's a deep report by Mandiant and Google's threat analysis group. These hackers are linked to China, and it is showing the growing seriousness and escalation of cyber threats in 2025. Private markets continue to dominate. The largest ever leveraged buyout deal is a $55 billion deal for EA, the video games maker. There's also a huge fight brewing between the big gorilla and health IT. Epic's partnership with a bridge allowed them to grow into 150 health systems. But earlier this year, Epic broke up with a bridge, and now they're competing with them with a new tool that they launched with Microsoft. It's risky business in a market dominated by just one big company. TikTok drama continues. While the president signed an executive order just a few days ago giving TikTok to a consortium of private investors involving Oracle and Silver Lake and Rupert Murdoch, this $14 billion deal is thought to undervalue the asset, and it does not give any detail about the core question, which is who will control the algorithm? Will it be the United States or will it be China? And this is important because current law requires TikTok to be banned in the United States unless China divests the asset. The US is continuing to push an industrial policy to try to safeguard part of the supply chain, including critical minerals. The latest investment appears to be a lithium mine in Nevada, and it comes on the heels of big investments in Intel and another mine called MP Materials. Investors are trying to make the most of the current stability in the markets. There have been 255 IPOs this year compared to just 146 in 2024. And that's probably good news because, as we said at the top of the show, the indicators in the auto sector seem to reveal that it's probably going to get pretty rocky for all of us over the coming months. As always, thank you so much for joining us. We appreciate having you here, and we'll see you back soon. Thanks for listening. If you liked what you heard, leave us a review, subscribe to the show, or check out another episode. We appreciate your support.